So, picture this. One single day in February, and three things happen that seem totally unrelated, but together, they just completely shake up the fintech world. You've got an AI assistant that's spooking Wall Street, a huge bank merger changing the whole game, and then this under-the-radar payments company that shows its cards. And wow, today we're going to connect those dots and show you what it all means for the future of your money.
Okay, let's set the scene. The date is February 5th, 2026. Now, you might be thinking, what's the big deal? Well, it might seem like just another Tuesday, but this was the day that all these undercurrents in the tech world just kind of broke through the surface all at once.
If you felt that the vibe in the market has been, a little weird lately, you are not going crazy. There's this nervous energy, especially in software and tech. It's like the party's over and the bill's coming due. You know that feeling when Netflix finally cracks down on password sharing? You knew it was coming, but it still stings. It's kind of like that.
So first up, let's talk about AI giving Wall Street the heebie-jeebies. The thing that really kicked off the latest panic was from a company called Anthropic. They unveiled their new AI, Claude, and they called it a coworker. And that one word, coworker, sent a shockwave through the entire software industry.
Think about how we used to work, right? It was this patchwork of different software subscriptions for every little thing. You had one for this, another for that. But the new way, whoa, it's a single, powerful AI assistant that doesn't just help you organize your work, it actually does the work for you. And that is the disruption that has everybody so freaked out.
And this, right here, is the killer question on every investor's mind. If your business is basically just a pretty user interface on top of a simple workflow, you are in big, big trouble. Because in a world where an AI can just replicate that entire workflow in a few seconds, you have to prove you're more than just a slick design.
And this hits fintech right where it lives. Fintech isn't just about cool-looking apps. The real guts of it are these super complex, highly regulated workflows. We're talking about stuff like underwriting loans, handling disputes, all that AML and KYC compliance. These are the exact kinds of repetitive, data-heavy tasks that an AI coworker is built to just gobble up.
Okay, here's a really great way to think about it. This whole thing is basically Spotify wrapped for software companies. Investors are looking back at the last few years for every company and asking, so, what did you actually accomplish? If your product was all flash and no substance, well, your valuation is about to get a pretty brutal reality check.
So, is AI the end of fintech? No, not really. But you better believe it is forcing every single company to prove its real value. A pretty UI isn't a defensible business anymore. You've got to own the messy, complicated, regulated plumbing underneath that nobody else can easily replicate.
Okay, so while all that AI chaos was happening, the old-school banking world was making some massive moves of its own. In a deal that just rocked the industry, Banco Santander announced it was buying Webster Financial, and this is going to have huge ripple effects.
We are talking around $75 a share. This isn't just some small tuck-in acquisition. It's a massive deal, and it's a huge signal that a new wave of consolidation is coming for U.S. banking.
And the impact? It's immediate. This merger instantly creates a brand new top 10 bank in the U.S., a total behemoth that's going to dominate the Northeast. This isn't a minor shift. It's like someone took the financial map and just completely redrew it.
And for all the fintechs out there, this changes the entire equation. See, Webster was a go-to partner for a ton of startups, but this new, much bigger bank, they're going to be way harder to work with. Plus, Santander is obsessed with low-cost deposits, which means fintechs now have to fight tooth and nail for every customer dollar. It's a direct challenge to that whole fintech dream of owning the cool customer app while the bank does the boring stuff in the background.
You know what this is like? Culturally, it's the banking version of Disney buying Pixar. You have this huge, slow-moving corporate giant acquiring a smaller, more nimble, more innovative player. And what's the likely result? A whole lot more bureaucracy and probably a lot less of that innovative spark.
So what's the bottom line here? No, consolidation isn't a death sentence for fintech, but it is jacking up the price to play. The barriers to entry just got a whole lot higher, and it's going to be much, much harder for new companies to break through.
All right, on to story number 3. And this one's a little different. While everyone was distracted by AI and bank mergers, a company called WEX quietly dropped an earnings report. And it tells a fascinatingly different story. WEX is that quiet kid in class who's been acing all the tests while everyone else was busy chasing trends.
Just look at these numbers. Come on, almost 18% growth in corporate payments, nearly 10% growth in benefits. This isn't the flashy, look-at-me consumer stuff. This is the essential, kind of boring, and incredibly profitable backbone of the economy.
So you might hear WEX and think, oh yeah, the gas cards for company trucks. But they are so much more than that now. They're a full-on commerce platform that powers huge industries, from healthcare to corporate travel. They're the plumbing that makes a huge chunk of the modern economy actually run.
I absolutely love this quote because it just nails it. WEX figured out how to turn a simple card into this powerhouse tool for all these boring grown-up industries. And you know what? In fintech, boring is where the real money is.
And that, right there, might be the biggest lesson from this one wild day. The fintech companies with the most power, the most resilience, they aren't the ones you're bragging about on social media. They're the ones quietly powering the essential, unglamorous spending that makes the world go round.
Okay, let's bring it all home. What does this all mean? We had 3 seemingly separate events, but they're all part of one big story about the future of fintech.
First, the fear of AI is very real, and it's forcing every software company, especially in fintech, to prove that they have something truly special, something deeply defensible that can't just be copied by an algorithm. Second, the big fish in the banking pond are eating the medium-sized fish, and that's bad news for the small fintech startups. The price of admission to partner and compete just went way up.
And third, companies like WEX are showing us where the real durable power is. It's in owning the unglamorous infrastructure, the payment rails, and leveraging the absolute mountain of data that flows through them. So it leaves us with this one big question, right? Is the future of fintech really about disruption and flashy apps anymore? Or is it becoming a game of being the best, most reliable plumber, the one who quietly keeps the whole complex system running smoothly? The answer to that, well, that's going to define who wins and who loses in the next era of finance.